Coming off the back of the worst day for equities of the year so far and trying to bounce by just 0.2% on the S&P 500 from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, bonds and equities climb and fall together, waiting for some potentially stale Fed minutes, and China says its relationship with Russia is rock solid. We begin with a big issue. Will February confirm the January boom?
January was strong.
January data were so tough.
Exceptionally strong data.
The payrolls number and the retail sales and the CPI.
We want to see confirmation.
Confirmation in the February data.
Confirmation of the trend.
Waiting to see if those numbers are actually confirmed.
We have to get more clarity.
A few more data points that hopefully align in one direction.
We do think you'll see moderation.
Maybe January was a one-off.
The downside risk is higher than the upside risk.
A lot can happen in the data.
You just have to look at the data.
So let's look at the data. Joining us now is TPW's Jay Pawlowski, Darryl Cronk of Wells Fargo alongside him. 30 minutes out from the opening bell. Gents, great to have you with us. Let's set the stage. Two-year yield, close to the high since 2007. Equities off the back of the worst day of the year so far in the S&P 500. Darryl, to you, do you see a good chance that the February data confirms the boom we saw last month?
No, I actually don't think that the February data confirms the boom last month. I think to steal a word that was somewhat polarizing 12, 18, 24 months ago, I think the January data is somewhat transitory. I think it fades into February. Certainly, there's reason to look at the strength when you look at the PMIs, you look at the payrolls, you look at strong retail sales. But I think when you get underneath the data, John, it's not as strong as what people believe, and I think February and March will start to confirm that.
The early February read on the February data is in the PMI for the last 24 hours. 8-month high, was sub 50, now north of 50, I think for the first time since last June. Jay, do you believe that the January boom is transitory?
Well, I think we're in the beginning, John, of a new global growth cycle. It's not just the U.S., it's happening in Europe. The PMI is above 50. Consumer confidence at a one-year high, PMIs in Japan above 50, China starting to reaccelerate. So I think the bond market is trying to make sense of all this and has gone a long way to making sense of it. You and I talked several weeks ago, and I told you we didn't believe in the bond market rally, and it's all given back and even more. But I think the real key here, John, is the dollar. And the dollar is not really confirming the bond market sell-off. So that, to me, really speaks volumes.
When you say it's not confirming the sell-off, what do you mean by that, Jay? We've come down from 110.33 on euro dollar down to about 106. What were you looking for?
Well, I'm looking at DXY, John, and it sold off pretty. I mean, first of all, it's had a big move last year, 15% rally. It's given some of that back. It's had a little bit of a bounce, but yesterday, for example, it barely moved right around 104, even though bonds sold off 10 basis points in a single day, which is a huge move and caused the equity sell-off that you noted at the open. So to me, really, I see several things happening, right? Bonds have flipped from the most anticipated recession to worrying about a 6% Fed funds rate. Stocks had a big move off to start the year. They've given some of that back. Importantly for us, it's confirmed the non-U.S. outperformance, which has been maintained over this little pullback. Commodities are not confirming any kind of big global growth boom, right? GSG is on the lowest it's been in the last 6 months. And the dollar, as I just noted, has not really confirmed a big move higher in terms of inflation or U.S. rates. So I think we're about at the end of this move. The confirmation of non-U.S. outperformance and the dollar not confirming a big move higher in rates says that we're pretty much done. And I think this is where you look for areas of opportunity, which is what we've been writing about for the last several weeks.
We can talk about those opportunities through the next 20 minutes or so. Talking about the commodity market, 6-day losing streak on crude. We're down again by 0.7% on WTI to 75.84. Just to bring up the bond market, Daryl, and what's been happening with bonds and equities. We came into 2023 and we all heard the same thing, that correlation, get my words out, between equities and bonds was going to break down. And Daryl, it's not happening. Yesterday was a great example of it. Treasuries down, yields up. They took equities with them. What's happening?
Yeah, I think Jay's right, but I think the difference on why the dollar's not confirming this is you're getting short-term rates higher, not just in the U.S., but across the globe. Japan's meaningfully higher on the short side of the curve. Europe's meaningfully higher on the short side of the curve. So I think the bond market, the U.S. 2-year's up 50 basis points already this month alone, in the month of February. So the bond market's coming back and basically telling you with that deep inversion, with LEIs, printing the 10th month in a row of declining, that tougher times are coming ahead and that the Fed has more work to do. And I think the equity market was late to acknowledge that. It's starting to acknowledge it now. And I think it's going to probably have some pressure as that data continues to weaken out into February and March here, John.
Jay, do you believe also that bond equity correlation can break too?
Yeah, I think only one of them can be right. We wrote a piece several weeks ago saying stocks and bonds, only one can be right. We think equities are right. I differ a little bit with Darrell on kind of what we expect to see going forward. Which we expect to see a gradual recovery in the U.S. economy. But importantly, John, as we've touched on, we don't expect the S&P to have a big year, right? So the fact that it got off to a great start at the beginning of the year and now pulls back, we think is healthy. The U.S. is expensive. Earnings growth is going to be, kind of punkish, plus 5%. So we're looking for a flattish type year in the S&P, plus or minus 5-10%. We don't think bonds are appealing, as we've talked about for some time. We don't like the long end of the curve. We do think it's kind of getting closer to where it should be with this latest sell-off, but we don't see it as attractive because we don't see a recession in the U.S. and therefore, we think the opportunities are better elsewhere where there's liquidity and growth starting to really percolate.
You don't like a 6-month T-bill at 5%, Jay?
It's becoming more interesting for sure, but I think, look, we think non-U.S. equity can be up 15 or 20% this year. So relative to that, no.
It's a big move. Daryl, I want your view on the bond market as well. I'm trying to work out whether you believe this is a once-in-a-generation opportunity to lock in some yield here, or a new generation of high yields. And I talked about this a little bit earlier this morning. That's a really important point. If you believe it's the former, a once-in-a-generation opportunity, lock it in, take on duration. If you believe it's a new generation of high yields, then maybe you can do a little bit more than that. What are your thoughts on it?
Yeah, I think the way to position in the bond market today is, we would say, to barbell, right? Take advantage of those short-term rates you just talked about, a 5 handle on the short side of the curve. But also, we do think you're getting closer to long-term rates that make sense. Adding duration here, again, probably a little bit on the other side of Jay, we do think the U.S. is probably heading for a recession later this year. So locking in some of these yields at these levels probably makes some sense. What's also interesting is you're starting to see high yield spreads quietly leak to the upside. We started the month about 385 over. This morning we're 440 over. That's a decent move in high yield spreads quietly, underneath the surface, where quality is starting to give up the ghost a little bit from that big January rally.
Daryl, what explains that? Spreads were so tight. We came into the year and all of a sudden we were looking at 385 on high yield spreads. What explains the backup, given that we've actually had confirmation of better news in the last month?
I think people are just moving up in quality, right? I think they see that the headlines suggesting, as I mentioned earlier, I mean, if you think about, you have deeply inverted curve, which we know we've had for quite some time, often a very clarion good indicator of tougher economic times ahead, if not recession. LEIs are down for 10 months in a row, and certainly in recessionary levels and territory when you look at leading economic indicators. The M2 money supply and M1 money supply have contracted at some of the fastest rates, in recent times. So all of that, along with the operating leverage that is happening on income statements, are pointing to some harder times ahead. And that's with what we've already done, John. if you extend this idea that, we're no longer talking about a Fed pause pivot, we're backing out rate cuts in the back half of the year, and we're saying now the Fed has more work to do, and likely global central banks have more work to do to arrest inflation and get it to a level you want. I think all of that means a tougher time for the economy. So you've got to play a little defense here. And to your good point, the long side of the curve probably has some attractive rates if we end up in a recession and rates come down from here.
Next up for the Fed conversation, Fed Minutes, a little bit later on this afternoon, 2 p.m. Eastern Time. Mike McKee joins us now from Washington. Mike, I have one question. A lot of people want to know. Mike, can they massage these minutes, given how dated, how stale they might otherwise be?
Well, they can to a point, John, but remember, this was 3 weeks ago. And as the two intelligent gentlemen you have on with you today are saying, a lot's happened since then. It's a completely different world out there. We've had the jobs report, we've had the CPI report and the retail sales report. All of this has changed the market's perception of what the Fed needs to do, and it's probably given the Fed a rethink about what they're going to do. I mean, the picture being worth 1,000 words thing here is you take a look at the yield curve, just what's happened since the Fed meeting. You can see how much we've seen interest rates come up. And so that does raise a question of, can the Fed send a message through the minutes that are 3 weeks old that would change any perceptions, or do they even want to? I mean, we can learn maybe who else besides Mester and Bullard suggested 50 basis points were needed the last time. That would be important if there are a lot of people who are leaning hawkish. What were they thinking about a pause in rates at the time? Because you can sort of extrapolate out what that might mean for the future. Was there a consensus for rates going above 5.1%? I think this is the thing that people are really going to focus on. Is there any clue as to where the terminal rate might go? And then finally, the lagged impact of rates on the economy and what's their recession outlook. Obviously, things have changed since then, but it's good to have a starting point to look at. The problem with the minutes, John, is that old saying of it's very difficult to make predictions, especially about the future.
Mike McKee, thank you, buddy. As always, Mike, thank you. I went through the data yesterday afternoon, yesterday evening, and just looked at what we've learned since that Fed meeting. Chairman Powell said at the start of the month that the disinflationary process had started. Then 2 days later, we got payrolls at 517,000, unemployment dropping to 3.4%, a big jump in the ISM services index for the month of January, CPI not dropping, CPI looking sticky, PPI with an upside surprise, retail sales coming in month on month with a 3 handle, jobless claims still in and around 200K, and we got the first look at the month of February yesterday with the PMI. And that is no longer sub 50, it's north of 50. So, Darryl, I'll ask you that question, shall I? How stale are these Fed minutes going to be later this afternoon?
I think fairly stale. I think Michael's right. I mean, all the data you just rolled off, came after the Fed meeting. I do think it's interesting, and I agree with Michael's point about, Cleveland's Mester and then Bullard both were suggesting the Fed needed to do 50. I don't think that, that carried the day, and we'll see that in the meeting minutes. But I also think there's a debate raging about what March means. We think it's 25. We think it's 25 again in May. And it's probably a coin flip for June for another 25. So the Fed's slowing down to better understand whether the resilient economy reflects time lags from the past tightening or a higher R-squared short-term terminal rate. But the Fed is going to be looking for more work needing to be done. I think that's the clear clarion message that's going to come from the Fed meeting minutes. They're not interested in a pivot and pause, and they're not slowing down or stopping, I should say. They're slowing down to that 25 basis point consistent hiking, but there is clearly more work to do.
Jay, in the news conference, Chairman Powell was asked about whether they discussed the pause, and he said, look to the Fed minutes. And at the time, I think a lot of people thought that maybe the Fed minutes might be a platform, the stage for the doves to dance. And now, Jay, a lot of people see these Fed minutes as totally stale. How will you interpret when they come out? How will you interpret them at 2 p.m. Eastern Time?
Yeah, John, I'm not going to pay very much attention to them, to be honest. I really haven't for some time. I mean, the Fed has not been particularly accurate with its outlook, so I'm not sure we want to give it much more attention than it's due, particularly something as stale as what we're going to hear this afternoon. You know, we focus forward at TPW Advisory, and to us, the market's already done a lot of this work, right? The market is now pricing in a higher terminal rate than it did at the end of last year. We're now at 5.3% in August. The market is priced in 25, 25, and 25 going all the way out to June. That's in the price. So as we look at it, we've gone a long way towards getting rid of the recession call, which we never bought. We're in a higher nominal growth world. So to your earlier question about, you know, is this a one-off yield play, or is this the beginning of a more sustained higher rate cycle? That's where we are, the latter for sure.
Yep.
And that's because we're not going to have a recession in the U.S. There are no major imbalances. Housing is already bottomed, and the PMIs are turning up. So we really don't see that, and we don't see it anywhere in the world. We think we're at the beginning of a new global growth cycle that's emanating out of Asia. Liquidity provision out of Asia is significant. China provided more liquidity in the last 2 months, John, 3 times more liquidity in the last 2 months than in the prior 2 years. So we're in a global world. And Asia is providing liquidity and starting to accelerate. Europe is also. And we think the U.S. is going to, you know, have a decent year economically. The Fed, as I said, the S&P plus or minus 5 or 10%, not a lot of upside. The rest of the world is much cheaper, much less owned, and has the potential for a new global growth cycle in it, and that's where we want to be positioned.
We'll finish on that call in the next segment, Jay. You're going to stick with us. Jay Pawlowski, Darryl Cronk, coming up. Tensions rising a year into war.
Our support for Ukraine will not waver. NATO will not be divided, and we will not tire. Ukraine will never be a victory for Russia. Never.
President Biden meeting with Eastern European leaders before heading back to Washington. More on that up next.
There should be no doubt. Our support for Ukraine will not waver. NATO will not be divided, and we will not tire. We're going to announce more sanctions this week together with our partners. We'll seek justice for the war crimes and crimes against humanity continuing to be committed by the Russians. Ukraine will never be a victory for Russia. Never.
Global divide at risk of deepening as allies reaffirm their commitment around the war. President Biden meeting with leaders from Eastern Europe. Putin meeting with China's Wang Yi in Moscow as President Xi prepares for a visit, according to the Wall Street Journal. China's top diplomat is saying this morning the current international situation is indeed critical and complex, but the relationship between China and Russia is solid as a mountain and can stand the test of international risks. Team coverage starts right now with Anne-Marie in Warsaw, Mark Champion in London. AMH, today's events, go through them for us, please.
Yeah, Jonathan, well, yesterday was all about this solidarity with Ukraine. Today is making sure the United States wants to make sure they have this solidarity and support for the eastern flank. The president right now is in a meeting with the Bucharest Nine. These are NATO countries. They were either part of the former Soviet Union or now the dissolved Warsaw Pact, also with Jens Stoltenberg at this meeting. When President Biden said today, meeting these Bucharest Nine leaders was what he repeated yesterday, which is that Putin wanted the Finlandization of NATO, but instead he got the NATOization of Finland and Sweden. His essence there and what he wants to insinuate is that NATO is not just more aligned, but it's expanding under his watch.
Mark, how on earth do you think the U.S. is going to try and manage this relationship with China, given what we heard from China's top diplomat early this morning?
Yeah, it's getting increasingly difficult. You know, it's increasingly difficult for the U.S. to manage the relationship. It's also increasingly difficult for the Chinese to manage its partnership with Russia while trying to sort of not become explicitly part of the war. Supposedly, they're going to come up with a kind of peace plan. You know, whether China really wants to jump in and try to mediate a resolution to the conflict when neither side is ready to actually make any compromises is unclear. But there may well be a position that China is trying to take, which is simply to position China and Russia as kind of peacemakers, and with the audience as the rest of the world, the global South, the non-West world, and position the U.S. and its allies as warmongers.
Hey, Mark, is a good point. That might be the effort. Mark Champion, AMH, to the both of you, thank you. Just fantastic. Phenomenal to read those headlines this morning. China, the relationship with them and Russia, solid as a rock. There'll be more on that through the day on TV and radio. Back with us, Jay Pawlowski, Darryl Cronk. I want to come to you, Darryl. Your point on US equities. I know where Jay wants to be. It's Europe, it's the rest of the world, it's Asia, even with all this stuff going on. Darryl, the last time we spoke, it was IT, energy, the S&P, year-end 4,400, US over international. Darryl, is that still the case?
Yeah, I think you can balance it out a little bit at this point, John. International is obviously cheap. Jay makes that good point. If you get a more stable dollar environment, meaning you don't get the huge appreciation of last year, but you don't get significant depreciation from today's level, I think international can play much better than it has, candidly, for a decade. But I think within the U.S., you've got to sit, it's well documented that at today's rate level on the reset through February, that equity risk premiums valuations are not terribly compelling here. I think if you get inside of that, though, different from the broad index level, and you look at various sectors, you've got energy still has is triple the equity risk premium that the S&P is. Financials are almost double the equity risk premium of where the S&P is. Healthcare still looks attractive. So there's some places that you can kind of hide out here as the economic data, in our opinion, continues to soften and play. It's interesting. The last time we were at this level of rates, which was early November on the yield curve, John, the S&P was in the lower 3,700s, and it was just coming off a 3,600 number. The VIX was at 30 to 33. Today it's 23. So the equity markets aren't buying kind of the latest sell-off and the move in rates. We'll see if they play catch-up or if they go a different direction.
It's a good point, Darryl. I was looking at the same thing last week as well. Yields have really backed up. The equities hardly moved compared to where we were. Jay, I've got about 45 seconds left. For people who don't know you, tell them why you like Europe so much.
Well, we like non-U.S., John, including Europe. We think Europe is in an early recovery. As I mentioned earlier, consumer confidence at a one-year high. Stocks are cheap. Money is starting to flow back. Asia is providing liquidity. China is accelerating. Japan is going to exit yield curve control. Very attractive reallocation opportunity, both domestic and foreign, into equities in Japan. And we think EM is about to begin a major up move supported by China. So we think right now you can look to add EM, China. We like housing. XHB has had 50% pullback from its move. If we're close to the end of the rate move, which I think we are, and housing is interesting in the U.S. So places to play all around the world, John.
Hey, Jay, wonderful as always. Jay Pawlowski, Darryl Cronk. The world's coming Jay's way. Slowly. It's just taken a few years. Coming up the morning calls and later. Not too bullish, not too bearish. RBC's Laurie Calvasina. 4 minutes from the opening bell. Let's get you some morning calls. First up, Citi upgrading Alcoa to a buy, expecting shares to benefit as China continues reopening. Wolf Research upgrading Merck to outperform, pointing to a strengthening pipeline. And finally, Atlantic Equities downgrading AIG to neutral, highlighting the stock's rich valuation. That stock's negative 0.9%. Up next, RBC's Laurie Calvasina seeing upside risk to equities with investor sentiment rebounding. That conversation just around the corner, the opening bell. Up next. Three-day losing streak on the S&P 500 from New York City this morning. Good morning, about 15-20 seconds away from the opening bell. Equities yesterday, dreadful. Worst day of the year so far on the S&P 500, down about 2%, trying to bounce. Futures up by about 0.1% on the S&P. On the Nasdaq, up by 0.2%. There's the opening bell. Switch on the board and get to the bond market. Yields look a little something like this, down 3 basis points. The whole curve yesterday shifting 10 basis points higher. 2s out to 30s. We're down 3 this morning to 392. 14 after coming very, very close to 4% on a 10-year. Euro dollar not giving me much, unchanged, 106.48, and crude giving us plenty, or taking back plenty, depending on how you look at it. Crude down, negative for a 6th straight session. We're down another 0.9%, $75 and about 70 cents. We're about 25 seconds into this one. We're positive 0.1% on the S&P. On the Nasdaq, we're up 0.33%. One stock to watch at the open, TJX, the retailer under pressure after delivering a disappointing forecast following the likes of Walmart, Home Depot just 24 hours earlier. Abby has more. Hey, Abby.
Hey, John, and that's exactly right. It's the outlook once again weighing on this stock. We do have the stock down about 0.8%. And one reason that it's not down more, the quarter that they did deliver, it was decent, inline EPS estimates of 89 cents per share. They also beat the same store sales estimate, up 4% relative to the estimate of up 1.1%. But so interesting, John, this stock was not priced for perfection. The industry group overall up 13% year to date. TJ Maxx, including today's decline, down 2.3%. So that could be a reason that it's not down more as well. Relative to, again, that quarter that just was, it was pretty strong, in fact, in terms of the earnings. There you can see in the blue bars the 89 cents per share. And then you can also see comp sales going in the right direction. So that's a positive. Out of the pandemic, the stock is up, but not as much as you might think. I would think that it's absolutely soaring given the stay-at-home shopping trend for home. And that was a piece of the most recent quarter. They're seeing less of that. But out of the pandemic, up just about 23%. The question on today, because again, the stock is down, is it going to follow the route of Home Depot, which fell the most in a year, down 7%, or will it turn around like Walmart, up just a little bit? Again, that adjusted earnings outlook missing. Investors are a little bit concerned about that.
Abby, thank you. Different story for Baidu. Let's pick up another name. We're announcing a $5 billion buyback plan after reporting better than expected results. The company's CEO saying this: we have a clear path to re-accelerate our revenue growth, and we're now well positioned to make use of the opportunities that China's economic recovery offers us. That stock up by 5%. Katie Lyons has more. Hey, Kaylee.
Hey, John. Yeah, nice move at the open here. Yes, revenue growth was flat, but still the figure came in above analyst expectations. You have cloud computing strength helping offset some of the weakness in advertising. And when it comes to actual profit, it doubled in the fourth quarter. One analyst over at Vital Knowledge calling that earnings growth, quote, explosive. That is largely due to cost-cutting measures, including a 23% drop in R&D. But we know there is R&D going on, including that AI chatbot they're getting ready to launch next month. Plus, the other big news here, as you mentioned, that $5 billion buyback program, which is equal to about 15% of the market cap. And of course, that market cap has gone up substantially over the last several months, John. If you take a look at the stock's performance since the low at the end of October, it is up more than 80%. Absolutely remarkable, though. It's worth noting since the recent high back on February 7th, the stock is down about 12% from then through yesterday's close. That is part of the broader cooling off we have seen in the rally for Chinese technology stocks in particular, but really Asian stocks more broadly. Now the MSCI Asia Pacific Index, as well as the Hang Seng, each only up about 3% year to date. Compare that with a 4.3% gain for the S&P 500. And of course, Europe far outpacing all three of those markets, John.
Kelly Lyons, thank you. Let's get you the update on the year to date and the gains on the session as well. 3 minutes into the session, we're up 0.2% on the S&P, and the Nasdaq up about 0.5%. Year to date, up a little more than 4% on the S&P, on the Nasdaq year to date, up a little more than 10%. The Nasdaq bouncing back big time year to date. US tech companies continuing to cut costs. Intel slashing its dividend payments, preserve cash for future investments. Google extending its global layoffs within Europe, cutting 240 jobs from its operations in Ireland. Joining us now is Isabel Lee. Isabel, what's happening?
Hi, John. Macro uncertainties seem to be the big theme this year, which is why companies are rushing to cut costs. We have Intel slashing its dividend payment to the lowest in 16 years. So from 12.5 cents, they're cutting it to from 36.5 cents, they're cutting it to 12.5 cents, payable June 1st. So that's the lowest since 2007, and that's a 66% cut. Had they stayed with their current level, it would have cost more than $6 billion in 2023. The CEO did say that it plans to increase its dividend payout sometime in the future. So the chip companies, as we know, are still reeling from a steep decline, taking a hit in their profits. Intel is also eliminating jobs, and it's not the only one. Google also announcing layoffs. In Ireland, the company said it will cut 240 jobs, representing 4% of their 5,500-strong workforce. And recall that earlier this year, Google said it will cut around 12,000 jobs globally. So Google joins a host of companies drastically scaling back their operations. This includes Meta, Twitter, and Amazon. But, you know, despite this, if you look at the workforce of these companies, John, they're still not back to their pre-pandemic levels. So it remains to be seen if this cycle is indeed over.
Isabel, welcome to the show. This was great, fantastic. Let's talk soon. Isabel Lee there on some of the big moves we're seeing in tech. RBC's Laura Calvert-Ceil is saying this about markets. Looking ahead to next year, the stock market is focusing on 2024 when an earnings recovery is embedded in expectations. The key question is not whether we get a mild recession in 23. We think the market has already priced that, but whether we get one in 2024. Laurie Calvert-Ceil joins us now. Laurie, love catching up with you. You know that. Let's not bury the lead. Year-end price target 4,100. Do you still see upside risk to 45?
So look, we take a very quantitative approach to our targets, John. And as we go through the data, we have a few things that do point us to that 4,500 level. And so we've said that's not our base case. The preponderance of the models are getting us to 4,100. But 4,500 pops up a couple times. We see it on our valuation model, which bakes in some expansion if inflation moderates, as many have expected it to this year. And if we do get a couple of Fed cuts at the end of the year. Now, I know that's a more precarious assumption, but that's what the model gives us. If you look at the sentiment issue, which I think is maybe a little bit less controversial, if you look at the depths of individual investor sentiment at the end of last year, we were basically down around financial crisis lows for an extended period of time. And historically, when you've been below 10% in favor of the bears over the bulls, it's set you up for about a 15-16% return on the year. So that's something that gets us to a more constructive number at the end of the year. 4,100 is the base case. We still like that target very much, but we do feel like when we look at the sentiment work in particular, that if we're wrong, the bias is more to the upside in markets than to the downside.
Laurie, there are phrases that people hear, people at banks say a lot, things like under-owned, over-owned. We came into the year and they said that tech stocks was under-owned, and that's what suggested, really validated the rally we've had year to date. Where are we on that, and how do you gauge what is under-owned and over-owned?
So we're still pouring through the 13F data. So that's something that could potentially give us some clues. But I'll tell you, John, the street feels like it's flying blind a little bit on the institutional side because the CFTC data hasn't been coming out. And something that I like to watch there is the level of NASDAQ futures positioning. Now, what among asset managers in particular, that's been a great barometer, I would say, for the last 6 to 9 months. And it was something that really told us the market was about to kind of fall down and stumble a bit back in August because the NASDAQ futures were looking a bit over-owned. Last we saw a couple weeks ago, it looked like we were sort of midway through a rotation back in. We were watching that data very closely, but of course the CFTC issue, we just don't have that data at this particular point in time. It does feel to me though, like based on conversations, there are so many people who hate this rally, who hate the rebound in tech stocks. It feels to me like they're still under-owned at this point, but we'll see what the data shows when we finally get it back.
There's this line in your research about the messy post-crisis normalization. And Laurie, I just sat here thinking, what's normal anymore after a decade plus of zero rates? What is normal? What are we normalizing?
Well, what I think that we're trying to get back to is what it will essentially be a new normal, where rates will be a little bit higher. We won't have the same kind of support from the Fed. But we have to get to that point. And I think the point we're trying to make with that messy normalization period is everyone has wanted to say COVID is over. And you know what? I desperately want the whole sort of COVID era in markets to be over. But if you look back to the tech bubble bursting, if you look back to the financial crisis, it took a couple years for markets to get back on their feet and for us to get out of this period where things were chopping around a lot, when we were dealing with, sort of lingering recession fears, when we were dealing with, sort of getting out of volatility and frankly, for lack of a better word, all the drama that was going on. And I think we're still in that period where geopolitical angst is high. Some companies are still dealing with supply chains. We're still trying to get out of this, kind of Fed period. We need to get to that pause for markets to really settle down. But that's really what we're trying to say. Not that we're, going to go back to the way we were, but we're searching for that new normal. And it is just a messy, sort of return to that new plateau.
At the epicenter of that confusion, I think the retailers were there, tech firms were there too. Tech aggressively went out and tried to build capacity. Amazon, a decent example of that. You saw the retailers build up inventories and it all came at the wrong time and they had to drop prices. Yep. Laurie, Home Depot yesterday down 7%. They're warning that ultimately labour prices are going to hit their margins. I just wonder on the labour front, Laurie, how pronounced do you think that's going to be as a theme? And can top line growth grow quick enough in a high nominal GDP 2023 to offset some of that pressure in the middle?
I do think that margins are going to continue to be pressured by wage growth for a bit longer. And we know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched. I think at the end of the day, that's one thing the street is struggling to understand is what is the new normal in terms of labor. A lot of these wage gains are going to be sticky. I think, frankly, a lot of employees were simply seeing a catch up in wages that might have been deserved in the past. And I don't want to jump down that rabbit hole, but I don't think we necessarily can assume that we're going back to sort of the wages of yesterday. So I think that that is something the street is struggling to contend with right now. And frankly, John, as I think about those retailers that reported yesterday, I do understand why we had a bad day in the market, because coming into yesterday, it seemed to me a lot of the companies on the consumer side were highlighting resiliency in trends that we hadn't really seen, any kind of stumble. So I think there was a little bit of a turn that happened yesterday, frankly, that spooked markets a bit.
And Bank of America offers a bigger framework just to look at a little bit more, Laurie, and maybe I can get your opinion on that. Savita Subramaniam and the team over at BofA said this. They said the problem children from the GFC, financials, home builders and materials, and from climate risk, fossil fuels, have been starved of capital for 10 plus years. We like the capital deprived sectors. That from BofA. Laurie, does any of that speak to you?
It does, and I might focus on slightly different issues, but, I think Savita does fantastic work, and I think that's a really interesting way to look at the world. What we typically see around these big crises in markets, and again, I don't think we're completely out of the COVID era, but you tend to see big leadership shifts, right? So whatever was working heading into that crisis does not tend to be the leadership area in the market going forward. We talk a lot about industrials, which is a sector, frankly, we're neutral on. It's expensive. It has looked a bit crowded, but frankly, it's the only kind of interesting long-term secular growth theme out there that we hear when you talk about reshoring, when you talk about the trade war, COVID, supply chains, everything sort of encouraging countries and companies to make things closer to home. We think that's a dynamic that's not going to go away anytime soon. So we think, industrials may, for example, stay crowded and stay expensive for quite some time. But I like the way she's thinking about the world in terms of thinking about those paradigm shifts. I think the street is struggling to figure out exactly what those are, because frankly, there aren't a lot of, terribly interesting growth narratives out there right now. I would probably point you to a slightly different part of the market, but I do like that idea and I do like that basic construct.
Laurie, can we finish on energy? Because they were the big winners of the last 2 years, up 47, 48% in 21 and 22, up close to 60%. Laurie, they're looking at those winnings over the last couple of years and thinking, can that really repeat? Is that where the leadership's going to be in this next bull market? Even when it comes, if it's here already, I don't know. Laurie, your thoughts on that sector?
So I take a slightly different, kind of view on energy. I talk to some people, especially a lot of my clients down in Texas, for example, and I do work at a bank, that's got a lot of investment in energy across the spectrum. And I hear a lot of people trying to make a case for energy as the next big growth sector. I don't think that I quite buy that. I do like energy. I am overweight. I think it's more, though, for me, of an area that's become investable again. I look at the sector, I see, sort of shrewder management teams that are focused more on costs, that are much more focused on things like dividends and buybacks. I feel like the yield appeal of that sector is giving investors an alternative to utilities. I feel like the Russia-Ukraine war has made us understand that you can't paint ESG with a broad brush. And there is, sort of an interest there from a national security perspective. So I feel like it's investable again. That's what I really like about the energy sector going forward. I will tell you, it's still cheap. I do think, though, the problem with this sector in the here and now is that it didn't see its earnings expectations properly adjusted for 2023 last year. So areas like energy and financials are having to go through that downgrade process right now. Once we get through that, I think it'll be, kind of a more interesting place to be. But I do, strive. I would push back on the idea that it's the next big thing in growth. I think it's just investable again and not orphaned anymore.
Well, that's a big change anyway, relative to where it was. Laurie, this was great. As always, it's good to hear from you. Laurie Calvasina there of RBC. Equities right now positive 0.25% on the S&P. Coming up, crude falling for a 6th straight day.
Gas prices in the U.S. collapsed from 9 all the way down to 2. So that lower gas price due to a warm winter put a lot of downward pressure on oil.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up with Port of Los Angeles Executive Director Gene Soroka. That conversation at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
What about what happened in Europe? That's the big one for oil. Really big warm weather shock drove gas prices down sharply, particularly in Europe. We have TTF, dropping all the way down to 49 euros a megawatt hour right now. Gas prices in the U.S. collapsed from 9 all the way down to 2. So that lower gas price due to a warm winter put a lot of downward pressure on oil.
Oil extended its longest run of losses this year. WTI falling for a 6th straight session as markets await rate hike hints from the Fed minutes. This is U.S. natural gas futures dipped below $2 for the first time since 2020. Will Kennedy of Bloomberg joins us now out of London. Will, great to catch up as always. What happened to triple-digit crude on that one-way train to 3 digits off the back of China reopening?
I think two things happened. One, the change in macro conditions, the idea that rates are going to have to rise higher than people previously thought, and what that does to the dollar is always a significant headwind for commodities, and I think it's pressuring the whole complex right now. And then second, as you had Jeff Curry talking about, natural gas prices have just collapsed around the world as we've come out of the winter, and at the margin that allows for some substitution and is weighing on the broader energy markets too. Well, how much of this is just about the weather? In the natural gas market, it is essentially about the weather. I mean, we're through winter and it hasn't been as warm as people had expected, cold as people had feared on either side of the Atlantic, and that means that in Europe especially, there were plenty of stockpiles and the demand for the gas just wasn't there. So the price of near-term gas futures has just collapsed. And in the US, you've seen a similar pattern, and we've had a big outage at this plant on the Gulf which exports gas, which means that exports have been much lower than people expected. And it's just, we've seen prices in the US just collapse, down 70% since November, and as we see today, below $2 for the first time since the depths of the pandemic. Remarkable, just an amazing turnaround. And Will, thanks for the coverage as we followed and tracked all of this. In the Bloomberg story today, available on the terminal and of course on Bloomberg.com, there's this great paragraph that just goes through the temperatures. Across the contiguous 48 states, January was the 6th warmest on record. If you go through the 6 New England states as well as New Jersey, they were warmer, the warmest ever recorded, according to the U.S. National Centers for Environmental Information. New York, Pennsylvania, Indiana had their 2nd warmest January in data going back to 1895. Just gives you an idea of how warm it's been to start the year. Looking at energy stocks struggling once again off the back of some of this, facing a 7th day of declines with the index among the worst performing sectors this year. Kelly has more. Hey, Kelly.
Hey, John. Yeah, no surprise if you're seeing declines in oil. You also don't see energy stocks hanging in there very well. That once again is the case today. You're seeing some of the majors like Exxon and Chevron under a little bit of pressure here in the first 20 minutes or so of trading, down a few tenths of 1%. But of course, this year, they really have been sitting out the rally. Exxon roughly flat on the year, but both Chevron and ConocoPhillips down more than 10% on a year-to-date basis. The energy sector as a whole is down about 4% in 2023, down about 11% from its high last November. Obviously, a lot of that blame can be assigned to cooling oil prices, but we have to keep in mind the divergence we are seeing between those oil prices and the energy sector. While oil is down nearly 40% from its peak, that isn't the case for the S&P 500 Energy Index. Still, though, it is down on the year, actually the 3rd worst performing sector in the S&P 500 on a sector basis so far this year, after outperforming to almost a ridiculous margin in 2022, up 59% last year. And the 3 sectors that were closest to energy in terms of performance last year, down the least, are among the 3 sectors that are actually down the most in the S&P 500 this year as well, along with energy. So it's a story of last year's winners becoming this year's losers, John.
Big turnaround. Katie, thanks for that. About 22 minutes into the session, trying to turn around here as well, trying to bounce on the S&P, up 1/4%, on the NASDAQ, up 1/2% with some sector price action. Here's Abby. Hey, Abby.
Hey, Don. And yeah, that's the first up day that we're seeing so far for the S&P 500 in 4 days. Anemic volume, 20% below the average. Not a lot of drama, as you would say, relative to the sectors. Not surprisingly, more or higher, but outside of consumer discretionary, which is not entirely intuitive given the fact that you do have TJ Maxx down, but most stocks within that sector are higher. It's up 1%. The rest of the sectors not really trading more than 0.5% one way or the other. Healthcare, utilities on bottom, so defense not bid. Over the last 2 weeks, we of course have had this pullback And not surprisingly, we have some sectors that are down sharply, including retail, given the fact that what we did see with some of the retailers, including TJ Maxx and Home Depot. The transportation index down very sharply, down 5.4%. The semi-cap equipment stocks and the semis, the chips, they're giving back some of this year's big gain. And then the media, it's kind of interesting, John, because, of course, last week, one of those boards that we were looking at on the year up huge. Now it's some consolidation of those gains.
Abby, thank you. Your equity market broadly unchanged, positive about 0.25%. Your trading diary up next. About 25 minutes into this, equities are positive 0.2% on the S&P 500, on the Nasdaq up about 0.33%. If you check out the bond market just briefly, big turnaround from yesterday. New highs for the year, 3.470 at the close on a 2-year. Yields now lower on the session by 6 basis points. Your 2-year 4.66, your 10-year down 5 basis points to 3.8981. Let's get to the trading diary. Fed minutes coming up at 2 p.m. Eastern Time, followed by Fed speak from President Williams at 5:30, then Bostic daily on Thursday. Plus, we get US GDP, core PCE, and another round of jobless claims as well. New home sales, income and spending numbers, and new sentiment survey to round out the week on Friday. That rounds out this morning for me. Good morning to you. From New York City, this was the countdown to the open. This is Bloomberg TV.